All right. Well, Joseph, thank you so much for joining us for another market update video. I know it's been a couple months since we last spoke, but we're really happy to have you on again today. I think since we've spoken, there's been a lot of developments happening globally and in our markets. And I think one of the biggest headlines is just, what happened, as of we're filming this about a week ago, with the presidential election and Trump winning the race. And so from an investor standpoint, there are a lot of people thinking about, okay, what does that mean from, sectors, large or small or international or domestic, that, there's all of these speculations going on with the trade. But I want to get like your perspective of it, but also you look at it more globally outside of just, sectors or maybe size and style, those types of things. So
Yeah, sure. So I think a lot of people, including myself, saw in the weeks leading up to election that markets were pricing in the odds that Trump would win. And I think a lot of people, again, myself included, thought, all right, well, that's kind of the odds on bet, which means that's how we're positioned. And to some degree, that was true. But the response from a week ago today, last Wednesday, was that it wasn't at all the way baked in. And what we've seen since then is kind of all these pro-cyclical, pro-growth, pro-risk on trades that kind of characterize how people position for a Trump win have all really exploded. So you've seen small cap stocks outperforming large cap stocks. To a greater degree, you've just seen domestic stocks outperforming international stocks. You've kind of had an interesting dynamic where Bitcoin's up 1 billion% seemingly, and gold's actually down while the dollar
mhm.
is up as well. Another thing, you've had interest rates continue to climb, which was part of a trend that began well before Trump was elected. And we'll talk more about that in this call. But I think President Trump is definitely seen as the pro nominal growth candidate and now elected president. And what I mean by that is that when you think about the proposition for corporate tax cuts, when you think about the proposition for less regulation, when you think about kind of the America First through, again, less regulation and then tariffing on certain other countries that are, I think the administration views as a threat. That all really points in one direction to pushing nominal growth higher. When I say nominal, is that it's not just a real growth component. You have a component in there where I think you can see inflation staying consistently higher than it was maybe in the prior decade. And then at the same time, you see real growth growing through productivity, through greater earnings power, through less regulation. Obviously, tax cuts leads to greater growth as well. So that's really being expressed in more or less a euphoric type of manner in the markets right now. At some point that sentiment will die and we'll kind of get back to trading on, I think, single stock, macroeconomic type of fundamentals. But for the time being, that's the narrative that's pushing the trade. In the last couple of days, we've seen markets kind of stall out a little bit, but the move we've seen has been pretty big. I guess we'll see in time if it's warranted or not.
Yeah, I remember looking at the futures and small caps the next morning, and they were up 6%, which is just a tremendous move. Markets were up 2-3% pre-market, and those are trillions of dollars, that in added market cap in just overnight trade. So I think to your point, not everything was fully priced in, and there's a lot of euphoria around that. And at the time of recording this, markets are just kind of digesting seemingly at these price levels. So there's a lot yet to be seen, but you know, it, it- when we look at maybe seasonality or how we play into the end of the year, and maybe even how he is, picking some of the cabinet members, those can drive speculation one way or the other as well. So, but I think it's a good segue to talk about yields and where they're currently sitting, and how historically this has been a pretty interesting Fed cutting cycle, and where we've seen like the reaction in rates. I think, the day the Fed cut, the 10-year was like at 3.6% on the current yield on there. And now I think it's just under 4.5 or 4.4, right around there. So that's a pretty big, I don't, maybe you can speculate on why that ultimately that move and that rejection and in yields, why that ultimately played
Yeah.
out.
Sure, yeah. So this is probably the biggest thing I'm reading about right now. And it's everyone I'm talking about or everyone that I'm reading is kind of saying the same thing. This matters, just not right now. Basically, we need to be alert to the fact that we're seeing interest rates move like this. But the sentiment regarding earnings, the sentiment regarding the economy, the sentiment regarding especially everything around the Trump trade is just trumping, in effect, this move in interest rates. But it will matter at some point. And like you said, interestingly, the Fed kicked off a rate cutting cycle on September 18th, just a couple months ago. 2 days before that is when the 10-year Treasury bottomed, right around 3.6%. It's up 80 basis points, roughly, actually more than that as of right now, where we're making another local high here today since that date. And you think, okay, the Fed is cutting rates. Doesn't that mean rates, are coming down? And if you look back in past rate cycles, or look at the last seven rate cutting cycles, this by far and away is the biggest move up in interest rates for the 10-year Treasury. In most cases, it actually has come down as you would kind of expect. So the next question, okay, what's driving that? And you think it probably has to do with one of kind of two things. Does that mean that growth is kind of reigniting and being represented by this move in interest rates, or is it an inflation scare? Are people concerned that maybe the Fed is making a policy mistake that's going to lead to inflationary pressures, which is raising the back end of the curve? And if you decompose the move in rates, you kind of see it's a little bit of both. It's primarily growth expectations, but if you look at break-even rates, which measure essentially the projected inflation rate going forward, those have increased as well. So you have kind of a multi-layer dynamic where, again, President Trump being the pro-growth, the pro-nominal growth option that was decided last Tuesday between the two candidates, is kind of creating an environment where we think growth is going to rise, and that's both on the real growth and on the inflation side of things. So you get a dynamic where the 10-year is telling I just really have no business being south of 4% right now. And you can kind of couple that with the fact that we've talked about Eric offline, fiscal deficits aren't going anywhere. The Treasury for the last several years has been funding deficits on the front end of the curve, and at some point they're going to have to issue more longer term debt via coupon issuance, which that's going to put pressure on supply. There's just not a lot of reasons to think that the 10-year needs to be, again, south of 4%. Now, where it finally levels out, I think is going to be the next step with equity prices. Like you said, we're in a seasonality period right now where there's a feel-good trade on with President Trump being elected. You get to the holiday season, you just don't see, you see a lot of low volume up days typically in a year where the market's already up like this. So I have a hard time seeing things derailing what's going on right now into the end of the year. But at some point, especially if the 10-year keeps just bleeding higher, people wake up and say, okay, is it 4.6, 4.8%? Do we get back to 5? And if these levels get hit, I think you get people wake up and say, okay, this is a problem now. Not only for growth, but also because equity valuations are now well above 20 times going into next year. So it's something we definitely have our eye on.
Yeah. Yeah, it's really interesting to ultimately watch that, but it's seemingly, while the rate historically has been, or at least in the last few years, has been really attractive. You've been getting whipsawed as a bond holder. I even watched mortgage rates and mortgage demand coming into the Fed cutting. They went down a few points, and then almost immediately anybody who's trying to do refinancing after that, there's just no demand and rates spiked right back up. I don't know where they currently sit today, but I could imagine they're still pretty elevated, just like where the 10-year yield was right before the cutting cycle started. So, it's interesting to watch rates, and I like how I think I generally agree that most people right now are just sitting back and waiting and watching kind of things unfold and seeing where prices ultimately settle under this new regime, under the new after the Trump trade reallocation starts to happen. Um, yeah, I think that's a really big story that I don't think very many people are talking about.
Yeah.
So I guess when we look at let's talk earnings real quick. Let's talk about, fundamentals of companies, outside of just the exuberance and the euphoria of, deregulation and um, you know, and nominal growth. Where how have companies been holding up during this previous earnings cycle, and where are they likely to be headed into 2025?
Yeah, sure. So we kind of are on the tail end of another earnings season for third quarter. Coming into the earnings reporting period here a few weeks ago, expectations for year-over-year growth were about 4 or 5%. We've come in at about 8%, so pretty nice beat. Now that was really pared down coming into last month, coming into October when we started reporting. If you go back to the summer when we were looking ahead, it was calling for, something like that 8% growth. So I think we kind of, as is most of the case, analysts kind of sandbag going into reporting. Companies are able to beat, and you kind of the music keeps playing or whatever. But what's more probably important is expectations for 2025 have been pretty lofty all year. We're looking at expected earnings growth for 25 of 15% from 24 year over
Mm.
year. That's been pretty flat all year long. Usually see that number over the course of the preceding year start to tail off as the year goes on. Analysts kind of come out strong. Companies are again kind of play this game where they sandbag, they caution, and then they're able to kind of beat. Well, that didn't happen as much this year, and the projections have stayed pretty strong. So the bar is high for next year. That's at the large cap level, though. If you look down cap, especially at the smaller cap, earnings revisions have been negative essentially all year long. So we continue to see this trade that's been played out in markets where the big kind of get bigger and have the ability to maintain um, through this different business cycle that we're in right now, where higher interest rates, a number of different factors are affecting smaller companies in ways that are not being affected by large companies, which are being able to maintain kind of this positive earnings momentum. So that's showing up though in the valuations. Like we said, the S&P 500 is well over 20 times for next year, and that's based on an earnings growth rate of 15%. And you look at earnings down cap, and they're much more near historical type of norms. Now we got a big bump here in the last week, like we said, with small caps up week over week, somewhere about 6%, I think, since the day before the election. So that all obviously is multiple driven right there. Earnings weren't revised up in one day, but it's based on the idea that policy changes, especially on the tax side, are gonna help with after tax earnings at the small cap level as well. Some of the deregulation things, but all in all, we look at earnings that they remain strong. You're just not seeing red flags yet from corporate America that say consumer spending is slowing. We're not seeing heightened signs of employment concern where employers or companies are guiding toward needing to pare back in that regard. So we are firm believers that, yeah, we look at the macro, we look at the data, we look at policy, whatever, but if companies are saying, hey, things are good, then it typically drives positive market returns. That's what we've seen. But we just continue to note this dynamic where there's really nothing to be that concerned about right now. Things really do look good. B, the problem with that is that things are being viewed that way and sentiment is being valued that way. So sentiment is pretty robust at this point. Positioning is pretty robust. Valuations are pretty high. So if we get something to hit the market that is unforeseen, and the whole point of something that hits the market, like a black swan type of event, is that you don't know it's coming. We can't sit here on this call and say I'm really concerned about this in 2 months from now, because that's the whole point of it, catching the market off guard. If that happens, we don't have much slack in the system to absorb that. But in so much as what we can see, things look really strong.
Do you think do you think things are priced to perfection right now and we're kind of a one bad economic report or one thing kind of making making headlines and markets falling? What do you think there?
Yeah, sure. So there's a little bit of fallacy to some degree in comparing. Okay, I think for next year we're at 21 or 22 times earnings. Historically, that's something closer to 15, maybe a little higher than that, maybe 15 to 17, 15
Mhm.
to 18, something like that. Call it. So immediately think, okay, that's out of bounds, right? Well, if you compare the index S&P 500 today to 50 years ago, it's much more asset light and profit margins are much higher today. So a dollar of earning growth, excuse me, a dollar of revenue growth today equates to a much higher earnings gain than it did 50 years ago. So we have an index composition that's different than it was. In many cases, to that degree, warrants possibly a higher valuation. So I see that argument for things, and I've heard that, and I tend to think that has some merit. So it's not to say that we're at 22 times. Eventually, this market has to pare back down to something more normal, like let's call it 16, 17, 18 times. That doesn't necessarily have to happen. But like you said, is there slack in the system? I think there's maybe more than in historical periods where we've been at elevated multiples, but I think it's pretty low at this point. Sentiment is pretty strong right now and getting even stronger, now that we've kind of got this again, this euphoria from the President Trump trade on. It just valuation acts more or less like a kind of the Buffett Benjamin Graham margin of safety type of argument. When it's high, you have less of that. So do we have a shock absorber in the system? Not much of one, although I did want to point out kind of that comparison that I don't think it means that at some point we have to return to the 50-year average of what multiples have been.
Yeah. How do you think that the market has been, as we look at where interest rates are headed and expectations, I mean the expectation on the Fed cutting has really diminished in itself, right? I mean, we got an inflation print this morning that what came in at expectations, but was elevated month over month, right? I think it came in at 2.6%. So that's inflation expectations have started to tick up. Fed cuts have started to come down. Markets are grinding higher, and earnings have been very strong. So I guess it's almost like the market doesn't. We're going back into a period of time where the market doesn't really care what the Fed is ultimately doing right now, or deviating from its original path. So, what are your thoughts there?
Sure, yeah, yeah. So if you go back to the late summer, so after the July Fed meeting into August, that was when some of the economic data was coming back weak. Had a couple employment reports that were a little bit questionable. There's just a few data points coming out that said, okay, the Fed's late to the party here. They need to do something. Then they cut 50 bips in September.
Hmm.
So what's happened since then? The data's come back anything but weak. It's been strong. Unemployment continues to be low. Payrolls are strong. 3Q earnings came back good. Of course, now we've got this sentiment around the President Trump that's very pro-growth. So all that concern about deteriorating growth or a weak economy has totally been wiped out. So you saw, if you go back to again that end of the summer period, there was this case that the market was kind of factoring in north of 10 cuts by the end of 2025. Well, we've seen three of those cuts now, but now the market's pricing in something like maybe three more cuts between now and the end of 2025. So kind of going from think about 10 plus cuts to maybe something like six, if you kind of compare it to where we were in August. It's all been because you've seen the narrative totally shift around what the growth path looks like. And you kind of said it. I mean, the Fed obviously has a lot of tools at their disposal and they wield a lot of power. But when growth is strong, when core companies are performing and people have a job, that ultimately is a bigger influencer over risk assets than what the Fed is doing. And right now, to some degree, they tend to both be kind of blown in the same direction, which is why the people scared about inflation kind of have an argument on their side and have some concern. You've got nominal growth expectations expected to rise, and all the while the Fed's continuing to cut. Maybe they're cutting less than they were going to, but they're still cutting. And that kind of creates this dynamic we talked about earlier, where this is the biggest move in the 10-year we've seen in a rate cutting cycle on the upside in the last 7 cycles going back to the 1980s. So something that's kind of like the kids' tests, like one of these things doesn't belong. I mean, that's sort of what it looks like when you look at the Fed cutting into this environment. And maybe we get a dynamic where at this point, the December meeting is about 2/3 chance of a cut there. Maybe they play with that, they keep that one as it is. Maybe between now and then we don't get a lot of movement. But then coming into 2025, it becomes off the table again, because what they're trying to do is find that kind of neutral rate. They no longer want to be restrictive because they feel like they've got a good hand on inflation. We'll see if they do or not. But they don't want to be accommodative given all this kind of pro-growth sentiment either. So I think there's a good chance you get a cut in December, and then it's off until something, if and when something bad happens.
Mm-hmm. Yeah, it's really interesting to see that ultimately play out, and time will tell. Expectations, and if they end up don't cutting, and rates stay where they're at, and time will tell ultimately what's driving a lot of the rate decisions. So yeah. Anything else that you're looking at from out there that's happening in markets that might be interesting or that you want to share? You don't need a ton of data behind, but just looking at something might be interesting. Like, I think it's always fun to look at what's happening with assets and things that are breaking out. And Bitcoin is a just everybody's like scratching their head looking at that. Gold down, Bitcoin just north of 90,000 as of recording this, I believe. So it's pretty,
Wow.
yeah.
Yeah, I mean that's a tough one to comment on. If you think about maybe what makes sense, if you think about maybe a pro-growth president that's going to drive nominal growth, therefore increasing inflation expectations, then you would think, okay, maybe dollar down, Bitcoin up, gold up. We're not seeing that. We're seeing the dollar up, albeit against other currencies, which stand to lose against kind of America First tariffing type of policy. So that makes some sense. But yeah, gold down, Bitcoin up. Maybe gold's being used as a funding mechanism for Bitcoin. I mean, President Trump is, I think, pro cryptocurrency, and therefore, in any sort of regulatory environment that might have been seen as unfavorable for Bitcoin or the like, that's maybe a good move. I know he's talked about replacing SEC Chairman Gisner, even though, of course, you've seen sentiment change over Bitcoin in the last, call it 2 or 3 years. We now have spot Bitcoin ETFs. So I think that's probably one of the most sentiment-driven rallies of all this. Elon Musk has been very outspoken about cryptocurrencies. He's seen as being tied in very heavily with President Trump, and was even kind of announced as one of his cabinet members just yesterday in regards to kind of a shakeup of government efficiency and this sort of thing. So, you get markets that trade all, at high frequency off of sentiment, and you kind of get correlated trades going on that say, okay, well, if this happens, then this should respond. And I kind of don't care about fundamentals in the short term. I want to be long this if this happens. And that's probably some of what's happening right now. But yeah, the move that we've seen in some of these asset classes it's been big. It's been bigger than I certainly expected. It's been bigger than the market expected, obviously, because the front running didn't happen, not to the degree that we've seen over the last week.
Yeah, and to that point, it looked like the correlation between just the dollar and where gold is looking like that's what was driving a lot of that price, not necessarily yields, because yields were going north and basically topped out, and that's exactly where gold topped out as well. But I think the dollar was potentially driving more of that. But yeah, it's been interesting to see things like, I think to your point, it's more of sentiment, it's more, risk on type of environment with cryptocurrencies and those, this kind of like you can see the exuberance that's happening out there right now. Is, when you look at pricing an asset like that, I don't think anybody truly knows what ultimately drives that outside of just liquidity and sentiment as of right now. So, but very interesting to watch that drift higher though.
Yeah, yeah, absolutely.
All right. Well, Joseph, thank you so much for joining us again today, and your insights are always valuable. And yeah, we look forward to seeing how the end of the year plays out and what 2025 ultimately looks like and what's driving asset prices then. So, as always, thank you again for joining us.